Hello, welcome to an episode of Momentum Mondays. It's been a while. Hope everyone is doing well since the last time we saw everybody. Summertime is hard. We've already talked about that. Kids are out of school, traveling, vacations. Everybody's experiencing the same thing. So we do these as often as we can in the summer. Obviously, when school starts back up in the fall, it'll get easier to do these. We'll be back in the studio environment and we'll get these pushed out. But there's been a lot of development here recently in the last few weeks that we haven't seen um, really since February-ish, I would say, maybe. So anyway, today's Monday, June 16th, and we'll dive into, well, I'll throw it over to you. I'm having to get back into the swing of these. Got to get back over into the disclosures and kind of what this is and what this isn't, and then we'll break it down into kind of what happened last week.
Yeah, so just keep in mind anything you hear um, from our podcast and YouTube channel, social media channels is not intended for specific investment advice. Always talk to a financial advisor that you trust or visit us at momentumwealth.us. Be more than happy to have a conversation with you and kind of help guide you in your situation. So, yeah, and I would say that we have not done some of the Momentum Mondays, but that doesn't mean that we haven't been producing some pretty interesting content that'll be kind of starting to filter its way out here soon. So we've kind of shifted when we were not able to do Momentum Mondays. We've had a couple weeks where we were able to do some higher level production things that we've been working on for a few months. So a little teaser, a little nice tease there.
Yeah, nice tease. We'll see that come out probably in the next 2 weeks or so. Um, so that'll be exciting. I'm excited about that. I listened to one of the episodes we did yesterday, and it's a lot of good stuff. I really think it's going to be well received. So we'll see how that works out. But yeah,
And
let's jump into. Go
yeah,
ahead.
I was just gonna say real quick is because we've had these past few weeks while kids are out of school, you got baseball games, we got all these things happening and soccer camps and football camps and all of these things. We also have been welcoming a lot of new clients to the firm and a lot of new prospects that have responded very well to our outreach online and how we can help solve their situation. So if this is the first time that you're listening to Momentum Mondays podcast, this is our effort to really kind of give you a quick behind the scenes look of how we're viewing markets, a 30,000-foot view of any potential changes that may be on the horizon with our strategies, and just in general to keep you updated with a nice, calm perspective on all the positives and negatives that are happening in the markets.
Yep. Yeah, that's the goal. So we also like to look at kind of what happened in the past week. We'll look at a bit of, some economic calendar events coming up in the week that we are currently in. And we'll take a look at where we are year to date because it's been a while since we looked at that. So if we pop up the week of last week, June 9th, we see the S&P down 0.36, NASDAQ down 0.56, Dow Jones down 1.3, and the Russell 2000 down 1.42, largely due to Friday's close. We had some geopolitical events occur on Friday, which brought the market down, but really last week was a pretty good week up until Friday. And then it pulled down those indexes quite significantly, which caused us to be negative on the week. If we pull up commodities, we see gold up 3.64% last week, really on a tear. Silver up 0.86, 10-year bond. This is going to be the price up 0.83, which means the yield is down, which is what we want to see. And Bitcoin up 4.26. Bitcoin had a great week. It's been in the news. Crypto, everybody talking about what's referred to as alt season. We're seeing some of the XRP stuff. I noticed this morning was kind of taken off. So maybe we're finally getting into that environment where crypto is going to become, definitely a larger part of our portfolios. But it's going to come and help to kind of shore up everything else.
Yeah, it's a great alpha generator. Now, when you're looking at crypto, you have two camps of people when we're thinking about professional traders. Not really, I'm not going to say institution because institutions have really taken the buy and hold approach. which there's nothing wrong with when it comes to cryptocurrencies. But I will say that, we have the two camps that trade very short term on technicals and then trade kind of in the medium term on the halving and the alt season. Very interesting to look at both. I tend to favor the halving. I don't know how many more cycles we're going to go through where price movements are really going to be driven mainly by the halving, but for right now, at least for this cycle and the next cycle, I would bet that they are. And we're entering a very interesting point of time where you have the supply shock of the halving beginning to take effect. And this is on the heels of institutions and governments accumulating, acquiring, and or not selling any Bitcoin that they currently have. So we have the effect of the supply shock is starting to take place, and we're inching ever so closely to where historically you would expect alt season to kick up. And these things are very important because if you've been allocating capital to this asset class, you may be scratching your head and say, okay, well, we went from 15K to 100K Bitcoin, but we've been sitting here for 6 months, 8 months, 9 months. Now we're entering the phase where you will most likely start to see more price accumulation quicker, and especially with being diversified into various different what they call altcoins, or just different blockchains that serve a different purpose. They don't really compete with Bitcoin, as with things such as Ethereum, things such as XRP, also known as Ripple. I think we're entering that phase to where if you've been on that ride up with us from 15 to 100, now we're going to start seeing that ride from, Bitcoin 100 to Bitcoin 150, or from Ethereum, 2,500 to Ethereum 5 or 6,000. You're going to start. So it's very exciting. And, you know, we love to see, we think about gold when we turned on our gold allocation years ago, 2 years ago now. We love to see an alternative part of your portfolio really come in and hit hard and get some really good gains, especially when the market is weak or sideways. And that offers beautiful rebalancing opportunities that don't happen every year. They may only happen once every 2 or 3 years. So I'm not saying we're going to get that divergence, but if we do, it's going to be pretty exciting.
Yeah, I mean, that brings up a good point too, as far as diversifiers are concerned, because if you look at, we don't typically track like an aggregate bond on these charts when we're talking about this on Mondays. We do kind of internally look at that. And of course, we have some of those in our portfolio, but, there's a real effort underway from a lot of forward thinking advisors and analysts and people who trade, that the thought process is, how much longer are an allocation like we've historically seen to bonds, how much longer is that going to be something that people are going to want to do instead of having an allocation to something like a Bitcoin or some sort of other asset class that would maybe replace bonds, certainly since 2022, where we've seen bonds have such a difficult time. And then even year to date, we are, we're like up 1%, I think, on aggregate bond. So it's just an interesting conversation to have. It's one we're definitely having internally. We're not pulling the trigger on anything. We're waiting and watching, but it's something we're looking at the benefits, the pros and cons of. We're constantly talking about that. It's just an interesting conversation. I've seen more and more people have it over the past few weeks as sentiment has started to get better, certainly with retail investors. Um, everybody's kind of looking for what the place is for Bitcoin or crypto, or, maybe not the alts, because I don't know that you want to use them for that position, but certainly the more established ones, Bitcoin being the main one that people are talking about. So it's an
Yeah,
interesting conversation to be aware of.
I think Bitcoin is going to begin to operate over time more like a very long duration zero coupon asset. That's really, and ultimately gold kind of acts that same way too. But I think it's going to have a place in that. It's going to have moves just like a very long duration treasury would have, but not necessarily in response to interest rates. It's going to be very interesting to see. Treasury market's extremely liquid, extremely large. We are operating in a these last few years have really been an aberration of what most people have, in the interest rate environment most people have experienced in their lifetime, which is generally falling over a long period of time. And then we have that big spike up. I tend to believe the trend will continue downward. I don't know what that means. There's no way to really time that. In fact, timing the interest rate market can be very difficult. There's a famous hedge fund in the early 90s that just mentioned if you can get the interest rate moves 7 times, that's it, just seven. Start with 10 grand. If you can predict the move of long-term rates 7 times, you can turn 10 grand into $1 billion. It's not easy. So there's so many
What are
variables
you
that
waiting
are
on?
that are at play. Yeah, I know, right? Yeah, I'll report back next week. So it's very difficult to do, but I think people can more easily understand how Bitcoin can play that diversifying part in their portfolio and replace a portion of their fixed income, operate like a long duration debt instrument. They can understand it much better than they can understand the interest rate market and the treasury market. If you were really a green investor, a newbie that came into a diversified standard 60/40 modern portfolio theory account in 2022, you would have had your world rocked when the value of your bonds went down 20 to 30%. If you were just following a set it and forget it robo advisor type program, you would have just been shocked. So I think that people are waking up to it. And I think people it's easier for them to understand Bitcoin, digital gold, scarce asset, programmatic monetary policy, than it is for them to understand how in the world can I buy this safe bond and then, why is it down for 30%? I'm still getting my 2% coupon, but now it's worth, if I put 100 grand in, it's worth 70, and it may take 6 years to get back to par value. So
Yeah, I still don't think they're do. I still don't think the common knowledge is there about Bitcoin as a store of value. I still think people are on the transaction train of it, and certainly that's sort of in the news where people are buying things with Bitcoin and companies are accepting Bitcoin. Whatever. I think that's largely sort of a diversion, but store of value is definitely the way you want to think about it. And then some of these other protocols that come lay on top of it allow for the more transactional nature of crypto in and of itself as an asset class. But that is, a conversation for another time for sure. But it's interesting to look at. But yeah, you're right. When analysts that I've seen are talking about that, they're talking about your sort of new version of your modern portfolio theory where you're having equities and gold and crypto rather than bonds. And so it's going to be interesting to see how that develops over time and whether that is more widely adopted. Or maybe your bond position is much, much smaller and it plays a different role inside the portfolio than it has historically done. Or maybe it works for a decade and then it doesn't work anymore. So it's always constantly, something that you have to pivot to and watch. But if we kind of look at where we are year to date, we've got the S&P up 2.17, the Nasdaq up 3.23, the Dow Jones down 0.13, and Russell 2000 still down 5.25. And this Russell 2000 is, I along with a bunch of others just left scratching our heads about the Russell 2000 because I feel like we've been talking about this for way too long, and we're not seeing any kind of productive, um, you know, push forward. I guess it had a good week last week, but we need to see more from these small cap companies. I'm not sure what that's going to take. Gold is up 30.63% year to date, the clear winner. Unbelievable. We're in June, beginning of June, and we've got gold up 30%. Silver up 25%. 10-year bond price is up 3.62, which means the yield is down on the year. And then Bitcoin up 13.96. So Bitcoin has made a lot of progress here in a very short time because last time we did this, Bitcoin was actually down on the year, I believe. So it's interesting to look at for sure. We've
yeah, I mean,
got,
I think just real quick on the small cap, rates have to get lower. Full stop.
yeah. Well, I mean yeah. The problem is when is that going to happen? Like you're saying, timing the rates.
Yep.
I don't think it happens anytime soon, and I could even be convinced that it doesn't happen this year. But that's going to be, there's a lot of much smarter people than we are working in the background of that, and looking at things that we're not aware of. And, you have certain inflation metrics showing a slowing of inflation. You've got other inflation metrics maybe alluding to the fact that it could be um, growing a little bit, although small. It's just uh, it's a very difficult spot to be put in, um, for what they have to do with the Federal Reserve and the dual mandate. You are seeing, we're even seeing in our client population layoffs starting to happen. People being let go from their jobs, unfortunately. This is something that's starting to happen. We had housing data come out last week. Buyer's market for sure. If we can get those rates down, they're going to be in a much better position. But you've got, uh, nearly 500,000 more sellers than buyers, which is the largest gap since 2013. Buyers are in negotiating mode constantly. Median sale price is about 7% below listed price. Um, we've got more inventory. We've got some real things that have to be solved. And again, I think the solve there for the housing market specifically is, again, interest rates. It all comes back to interest rates. So
Yeah, I
how
mean,
do we get to where we need to be?
it's,
And I don't know the
it's,
answer to that.
I don't, it is difficult what you're saying. There are massive amount of data points, but here's one data point for you. The Fed is always too early or too late. So they have 100% guarantee so far of getting it wrong.
Yeah.
So
But
there,
it's
there we go.
because of, well, it's because of the structure of the Federal Reserve. It's because of what they have to look at. If somebody along the way decided that whatever it takes, I don't even know what it would take to get rid of the dual mandate, to just have the Federal Reserve be focused on price stability. Maybe that's the only thing they're looking at. I think you would find that statistics start to trend to the better side, rather than have them be so wrong, as frequently as they are. It's just because it's so muddied, because the two are almost conflicting. And so it's very difficult to get a read on, our price is stable, but also people are losing their jobs. What do we do? It's sort of like, it's
Well,
an unnecessary burden to the whole process.
they, I know we don't have a lot of time today, but you are correct in what you're saying, and I will just add to the fact that I don't know. It's always been perplexing to me when someone takes 2 hours to learn about the Federal Reserve. Why in the world do we allow what is essentially a cartel? It's a private cartel sanctioned by law to set prices when we would have a hissy fit if any other prices in the economy were set. So we're expecting these 12 people in this room to get the most important price of all, which is the price of money, correct. Not in a free
Yeah.
market, but in a very Soviet style top down, you know, oh, well, prices are going up. Well, we need 500,000 people to lose their job. Or
Yeah.
people are spending too much. Oh, we got to cool it down. It's always been perplexing to me. Well, we need to cool the economy down. Could you imagine someone getting a pay raise at work and then coming home and saying, "Oh, honey, I don't know. We're going to have to cool our household budget. Things are getting a little too hot. We're making too much money. It's just we got to cool it. We got to put the brakes on and not make as much money." It's silly, but at the same time, I understand. But it's a losing proposition no matter what they do. But when again, I think the price of money should be what they focus on with price stability, like you said, and getting rid of the other side of the mandate, because that's really that's a very very important function of the economy. And when you have interest rates go up as fast as they did, as high as they did, that's never happened before in history. I know people will say, well, in 1980, it was 12%. Yeah, but it didn't go from 0% to 12%. It went from 6% to 12%. That's a doubling. We went from 0.25 to 5.5%. It's an order of magnitude of an increase, two orders of magnitude of an increase. That's never happened before. And I think it's really putting strain on certain parts of the economy. and they went for I got to stop talking. I know we have time, but I was just getting on a rabbit trail here. They went for a decade from 2010 to 2020. They wanted inflation. They wanted it. They wanted it. We got to get to 2%. They were at 1.3, 1.5. They even said we'd accept a cumulative, even if we ran hot 2.5 or 3 for 5, 6, 7, 8, 9, 10 years, and it averaged out over 20 years to be 2%. We do it because we want it so bad. And then now inflation, as reported by the government, is sitting at 2.3, 2.5, and they are still holding the Federal Reserve rate 200 basis points into restrictive territory. It's peculiar, but here we are. It's not up to us.
Well, I mean, nobody, very few people, I should say, maybe not nobody, very few people were alive in 1913 when we didn't have the Federal Reserve. And so, it's sort of this thing that has always been for a very large, the majority of the population. And so even before that, banks set their own. So you had really, in effect, JP Morgan Chase, again, this totally off topic, but JP Morgan Chase effectively acting as the central banker in a lot of those cases. But there was always somebody, even if it was banks, setting the rates. But it's definitely, uh, they were just looking at it from a rate side. I don't even know when the dual mandate was instituted, but they were always looking at it from
60s.
the rate side. Okay, so they were always looking at it from the rate side, and maybe that's slightly better. Maybe that works a little better, makes the decision easier.
We'll see. And it's easy to complain about it, but hey, we have the strongest economy essentially in the history of the world, albeit it has problems. But it's very liquid, very powerful economy. So it's easy to complain about things when you have something that's working. It's done really. It's presented an enormous amount of opportunity for people to provide for themselves, their family, grow businesses, hire people, lift the entire country upward. And it's easy to
Yeah,
complain and backbite. So we get that. But hey,
and
we want to see
despite
interest
all of
rates
that,
go down so that small cap can go up.
yeah, but despite all of that, so we have the American Association of Individual Investors, the AAII survey, and thus far, it's been really bearish. We've seen a turn of that in the last few weeks, which is retail investors becoming more bullish. It's still a little bit low. When you're looking at the sort of averages, you want to see it a little bit higher, but it's very, very close. The bull bear spread swung 3.1% last week. And that signals kind of increased net optimism. We're sort of in a neutral sentiment standpoint, but momentum is shifting for sure. And
While
so that is
margin
something
debt,
we want.
while margin debt is down, and that's also important. Margin debt is down and sentiment is shifting upward. That's a very important metric as well.
Yeah, and all of this is obviously within the context of whatever goes on in the Middle East is not it's not related to this. So that's sort of what came in and kind of hammered us on Friday. I think the market is open now as we're talking, and I think we're maybe up. Yeah, markets are up today. So, depending on what happens globally with these kind of geopolitical events, this could throw a wrench in everything. But what we're looking at going forward is very positive. We're seeing the positive signs start to build, and we're seeing things that we want to see. And so, I think that's going to give us more confidence in the forward trajectory of the market. Certainly, a lot of damage has been repaired, um, and that's what we want to see. That's what we like to see. We got some things going on this week. Most importantly, I guess, well, we've got a short trading week this week. Thursday markets are closed, I believe, and then Wednesday the Federal Reserve is going to be giving their decision about rates, which we would expect them to just hold, just be in a holding pattern. I wouldn't
Yeah.
expect any movement there.
Yeah. Well, it's going to be very interesting to see how everything plays out. I think you're 100% right. The vast amount of data that we take in and analyze daily and weekly at the firm in building higher degrees of confidence on allocation positions and near term movements of the market, long term movements of the market. The data is looking very good, but we are kind of still in that holding pattern on certain portions of the portfolios until we get more validation and look for these areas of growth potential. So, but it is, yeah, it's been very interesting to see how things have played out, and we'll I'll text Jay Powell when we get off, see if I can get a scoop, and we'll go
Yeah.
from there.
Yeah, sounds good. Let me know what he says. We've got some upcoming retail data and also housing data will further kind of give us a little bit um, more information. But for us, all eyes on the Fed this week, how they interpret their mandate, how they interpret the geopolitical stuff going on. Oil surged and then fell back down over the weekend. So that's interesting. The fact that the market's up today is also very interesting, based on what happened over the weekend with Iran and all the news about is the U.S. going to enter that? Are they not going to enter that? What's going on with that? So I would keep an eye on that. That is just like the overarching, you know, point to keep an eye on. But what we're seeing on the fundamentals of the market, it is very much better than it was 45, 60 days ago. But again, we have tariff conversations coming up. I know they're going to be announcing, or they say they're going to be announcing a bunch of deals. So we'll see where that goes. Um, we'll just kind of keep an eye on it. But yeah, that's about it for us. I think we got to wrap it up here because we've got some appointments coming up. But um, as always, you know, share this video, like, subscribe to see the content that we put out. You're going to be, informed when these videos come out if you're subscribed to the channel. And if you have questions, reach out, let us know. We're always happy to help. Um, anything else from you?
No, no, we got a lot of stuff coming up today, and we're gonna get cooking here. Any questions, concerns, always reach out to us. Like Garrett said, like, share the video, and other than that, we will be talking to everyone very soon. And happy investing, momentumwealth.us. If you don't have an advisor, you have one now. Momentumwealth.us. Reach out to us.
Yeah, we'll see you guys next week.